So being a full-time investor, starting over can just be kind of a part of the game. In real estate, we're subject to different types of market conditions or even subject to financial collapses that can wipe us out. And this happened to me in 2008. I had been working full-time as a wholesaler and I had saved up about $500,000 in cash. So I bought a property that I didn't quite know how to renovate. And by the time I had got this property completely fixed up and it looked amazing, the market started to collapse. And it completely wiped out my cash reserves. I had no more liquidity, I had no more assets that I could lever off of, and they were just causing cash sucks. This required me, as a 25-year-old kid, I had to restart and start over. It is James Dainard, and we are back on BiggerPockets YouTube channel. For those who don't know us, we are active investors in the Pacific Northwest. We've been investing for almost 20 years. We buy and hold properties, and we also flip a ton of properties. Since 2005, we've been involved in over 3,000 flip transactions. With every transaction, we learn a lot of different lessons. With every transaction, we build a lot of new relationships. And the longer we do this, the easier it gets for us, just based on the relationships we've built, the resources we've built, and the systems that we've had to put together over time. But with every market, there can be corrections, and sometimes as an investor, you have to start over. And we've already had to do that once in 2008. So being a full-time investor, starting over can just be kind of a part of the game, and it's something that you can learn at any time in your career. It doesn't matter if you're new or experienced. In real estate, we're subject to different types of market conditions or even subject to financial collapses that can really affect us as an investor and can wipe us out with our liquidity or even our assets. And this happened to me in 2008. So in 2008, which was about 15 years ago, I was 25 years old. I had been working full-time as a wholesaler that was selling typically between 15 and 20 deals a month. And I had saved up about $500,000 in cash, and I had bought 9 rental properties at the time. In addition to, I started expanding my business footprint and I started learning how to flip houses, and I bought my first major flip. I'd already done a couple condos in the past, but I went into that first big project. So I bought a property that I didn't quite know how to renovate. I had to learn a lot of hard lessons. I went way over budget. It took double the time frame that it was supposed to. And by the time I had got this property completely fixed up and it looked amazing, the market started to collapse. Subprime mortgages were taken away and the banking market locked up all the way in. And at one point I listed the property. It was pending at $500,000. The buyer fell apart, and then I chased the market for the next 9 months. Fast forward 2 years later, I ended up selling that property for around $280,000. So I went from selling it for $500 down to $280, and it completely wiped out my cash reserves. In addition to, during that time, we saw values plummet, and a lot of us were on adjustable rate mortgages, so our rates on our rental properties also went up. And as we went into a deep recession in 2008 and 2009, rents also kind of came down and they flattened out. So then my 9 rental properties that I had at one point over $500,000 in net worth and in value increase had been shrunken dramatically. And it went from having over $500,000 in equity to being upside down by over $500,000. So in a 12-month period, I went from having $500,000 in cash, $500,000 in equity, to being in the red. I was over $250,000 underwater, and all of my rental properties were costing me about $4,000 a month in negatives, and it was bleeding me dry. This required me, as a 25-year-old kid, I had to restart and start over. I had no more liquidity, I had no more assets that I could lever off of, and they were just causing cash sucks. So with a lack of investors, because they all kind of got wiped out, we were wiped out. We were really starting over from scratch, and we had 2 options: either go get a different job, which I didn't want to do, or figure it out. And what I've learned as an investor, when you have to figure it out and it's hard out there, it's actually the best time to grow and maximize the potential in a down market. But you have to take the right steps to get back into the market. So we're started with 0 money, we had 0 resources, but we had a lot of deal flow. In 2008, there was tons of properties available, but it was really hard to access money, especially because most hard money lenders at that time required 20% down. Now, after I just took a bath on a bunch of my flips and my rentals were bleeding me dry, I didn't really have the liquidity to do it, but we had 2 skill sets. The first thing that we had to do was we had to figure out how to go identify a good deal. There was tons of properties in the market for sale. There was 6 to 8 months worth of inventory, lots of opportunities, but how did you pick the right one? So we got really good at analyzing properties, predicting the comps, and figuring out what they would sell for by the time we were all renovated. The second thing we had to do was we had to showcase our skill set, because what we did know is we had renovated a lot of homes from 2005 to 2008. We figured out the right formulas to get these properties renovated, and we actually had a lot of construction resources available because guys were desperate for work at the time. So we knew how to find a good deal, we knew how to underwrite it, and then we had the construction skill set. The problem is we just didn't have the liquidity or the money to buy these things. What we had to do from there is we started reaching out to investors that we had built relationships over the years. We started sending out deal flow that we would secure out to other investors, but we realized that they were too nervous to buy the property themselves. And we started approaching them as joint venture partners. By bringing in equity partners, we took out the risk, so they didn't have to do the renovation or find the deal, but they brought in that money, that 20 to 25% of total project costs, so we could actually close on that property. So we got liquidity by partnering up with investors. It showed them that we could mitigate the risk by analyzing the deal, that we could facilitate the renovation plan, and then based with their liquidity of around 20 to 25% of the project, we were able to obtain financing for the rest and then buy that property. So we solved the first problem, get access to liquidity. The bad part about that is we were having to give away 50% of our deals just to get access to that money. But it got us started. The more deals we did with those joint venture partners, the more liquidity we started bringing in, and then we had to do less deals with partners. The next thing we had to figure out was how were we gonna get the right type of financing? It's not like it was, from 2020 to 2022, where there was access to tons of hard money. Not like that 2008, 2010. And honestly, it wasn't like that from 2010 to 2014. Most hard money lenders were asking for 20 to 25% down, and their average rate was anywhere between 12 and 14% and 2 and 4 points. That is okay that the cost of money was so high, we just had to work that into our pro forma. But as we were investors, we were doing these flip properties and we were giving away half the profit. As we did more and more properties, we started talking to not just institutional lenders, and we started networking with also private investors. Because if you're working with private investors, you can give them a higher rate rather than giving up 50% of your deal. So we started going to all sorts of network groups. We were sending out deal flow. We were talking to clients. We were talking to lenders, showing them that we had good deals. And we started talking to different types of private lenders. From there, we went from bringing on 50% joint venture partners. We got a little bit of liquidity together so we could pay all the hard money expense. And then we got our next hard money lender that really changed the game for us. The reason being is he liked us as people. He knew that we understood the asset and he knew we could implement the plan. He would finance us 100% of the purchase price and part of the rehab, and we just had to fund about 50% of the rehab. The bad part is his rate was 18% and 4 points. And he also wore a gold chain and old card robes. And I think I might not have kneecaps today if I didn't pay him back. So we had to find the right lender, and that worked for us at the time. A lot of the deals we were doing, we were able to buy properties with our equity partners, do a couple at a time, and then we would do 2 with this really expensive hard money lender, but we weren't giving away half of our deal. With every flip that traded, the goal was to build more liquidity. By building more liquidity, if I'm starting over, that gives me more gunpowder. That gives me more access to deal flow. That allows me to get buy and hold properties as well, or set up BRRRR style properties. So liquidity was key. So as our resume and our business expanded, that gave us more access to capital. That solved that issue for us as from starting over. The first thing we had to do was audit our liquidity. We started growing our liquidity by doing deals. As we grew the liquidities, that allowed us to do more and more flips. 2008, we were doing roughly about 6 to 10 deals a year. By 2012, we were doing over 100 flips at a time. So we had a lot of different deal flow going in. We had the capital, we had the right lending, and it allowed us to expand. But as you grow and you scale as an investor, you also have to scale your resources. So as we were scaling, we had to bring in more contractor resources, and that was also essential. So how we sourced contractors is we would go to other job sites, who's working in the area. We would look at what permits were pulled in the area, go drive by jobs, see what they were going on and working. We were networking with other investors. Who did they know? Who was working out well with them? And the more contractors and resources that we brought in, the more valuable our skill set got, and it got us into more deals. And as we're getting into more deals, we had to have the right broker team on our bench. In 2008, we were just flippers out there. We went with a broker that would charge us less. We wanted to get the discount listing. The problem is it didn't give us that service that we needed to scale up to where we were there at. So we started our brokers at Heaton Dainard Real Estate and trained brokers on how to analyze deals that could run all the performance for us. And then our listing team can do all the design work to where they could really help us move our projects forward. So we went from having a small team with low capital to a larger team that we had more capital. We had access to financing. We could fund and have over 100 projects at a time. We had sourced the contractors to come in and get these properties renovated. And then we had our specialty broker team that was able to help underwrite these deals to get us our deal flow and then get the disposition handled to where they would sell quickly. During that time, during 2010, the average market time in our market was around 120 to 150 days. By training the right staff or working with the right broker team as I was rebuilding, they were able to look at the market, see how we could optimize the price, upgrade it the right way, and we were selling properties in less than 14 days by putting in the right finishes. So having the right broker team helped us grow exponentially as well. One of the most impactful things I could have done as a young real estate investor was actually look at the outside influences. As a young real estate investor, I was only focused on housing, supply and demand, and what was going on in my local market. If I would have listened to podcasts like the On the Market podcast, it would have gave me more about the trends. I could have read in and saw what was happening in the banking market and moved my pieces around before I got collapsed on. It would allow me to build out a lot faster. So now I know today. I'm constantly paying attention to what's going on in the outside market, interpreting it into my underwriting and mitigating the risks. But sometimes in real estate or high risk investing, and flipping is a high risk investment, things can happen. We've seen over the last 6 months, rates get skyrocketed. They've been moved up at the fastest we've ever seen. That has caused a sudden jolt in the market where we've seen values drop 20 and 30% in specific neighborhoods in our local market. That can be detrimental for flipping. So some people are starting over today. And who knows, even with all the mitigation of risk, I at some point might have to restart if I keep playing in these high risk assets. I continue to buy high risk assets like development and flip because the reward is huge. Every deal we do, we get to go buy more rental properties. We get to invest in hard money and it pays us passive income. So it's never going to be something that we're never going to not do. But if we get caught and I had to restart today, the first thing I would do is create my business plan. What kind of flips do I want to do? Not all flips are the same. So narrow down what you want to buy. Based on what you want to buy, then the next step I would do is go talk to people with liquidity. If I have a skill set, I have experience, I want to go meet with the people that don't have those skill sets so I can raise money and fund my deals. The third thing I would do, network with every lender out there to find out where the money is and what the access to capital is. I would meet with every hard money lender in our Washington state market, find out who's doing loans, what's their product terms, how much they require down, do they give discounts or will they work with us based on our past track record. In addition to hard money lenders, I'm also going to be talking to commercial and local banks. These are banks that don't look at me on paper, they're going to look at me more like a business. When you're restarting over, you want to network with the right business bank that will help you get your goals. So having that business plan is also really fundamental with meeting with those banks. As I'm meeting with money partners and lenders, I want to make sure I have the right team behind me and I need to find more resources. Again, if you're starting over, or let's say the market crashed today and I lost all my money, that also means a lot of my contractors and resources are probably also going to go out of business. So I need to go find those contractors. I would drive for dollars. I would drive properties in the areas I'm trying to buy, go meet with contractors, see what projects they're working on. Are they working on flips? Are they working on burrs? Do they work with investors? I would go to networking groups. Where are contractors at? What investor referrals can I get them from? And also, I would look into who's pulling permits and not pulling permits in my local market because I can see what kind of projects they're working on and whether they'll be in a good box. So I would really go after that extra contractor resource and find the guys. Now, luckily, we all know it's really hard to find contractors over the last 24 months. When the market flattens out or gets leveled, it's actually really easy to find them. But you got to find the right guys that can implement the right plan because the right plan will get you more access to money and deal flow. So drive for dollars for those contractors. And lastly, if I was restarting over, I need to have the right broker that can help me guide me through the market. Not all real estate brokers are the same. I'm an investment real estate broker in the Pacific Northwest. I sell investment opportunities like fix and flip, development, BRRRR properties. I don't go out traditionally in real estate and go show people properties and have them write up offers. I only sell numbers. By working with a team like our team at James Dainard, it will allow a new investor to get into the market quicker. They know how to underwrite the property. They can help you through that transaction because in addition to, some investment brokers have access to resources that will also help you build out your construction team and your lending team. So the right investment broker can actually help you with your whole business plan and grow you faster. And when you're restarting, you want to get off that bench and grow as fast as possible. The more deals you do, the more liquidity you have, and then the sky is the limit. So I know over the last 6 months, it hasn't been that enjoyable for flippers, and we've seen some massive compression. I personally know some developers and flippers that are restarting over from scratch. They did awesome the last 2 years, but then this last 6 months was really brutal and they lost a lot of their liquidity. If you get into that situation, it's just important to take the right steps. Set the business plan, find the resources, and then go start looking for deals and rebuild back up. Because you're starting over from scratch doesn't mean that it's all over. If I would have stopped in 2008 and just got a 9-to-5 job, my life would look substantially different than it did today. So you can always rebuild. So I hope you enjoyed this video from BiggerPockets. If you did, like and subscribe below. And for more investor tips, check us out at jamesdainard.com or on Instagram at jdainflips. And I will see you guys next time.